Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Noah Hamman, founder and CEO at AdvisorShares, to discuss ETFs that get exposure to stocks that may provide alpha in both the downturn and the rebound. It is great to see you, Noah. Welcome back to Trade Talks.
Thank you, Jill. Thanks for having me.
And let's start with the macro backdrop. Despite the few days that the market is stringing together some green days, there really is a challenging macro backdrop, that's for sure.
There is. I mean, Chairman Powell has said it's going to get painful as they continue to raise interest rates and reduce their balance sheet. They're doing everything they can to fight inflation, and that probably means bad things for most investors' portfolios.
I want to talk about two ETFs today. We'll start with the first one. How can investors get exposure to recession-proof stocks?
Sure. So we look at that as a category that could weather, maybe a recessionary challenge well. Both, in the down market, they have a little bit softer landing. They're still going to correlate to the market. But then when we make that turn out, and we eventually will, they can rebound nicely. So it's really more for people who still want to be invested in the market, don't want to go to cash, don't want to hedge. They can look at these types of stocks and consider rebalancing their portfolio into some of these areas that might weather the recession challenge as well. And something like a Vice ETF, or certainly some of these individual sectors that you see on the chart, could prove well for an investor's portfolio.
Which ETF is designed for performance during bear markets?
So really, for that, you have to go either cash or inverse. So one of the ones that we look at is actually our Nasdaq Dorsey Wright Short Equity ETF. It's run by the team at Dorsey Wright. It's short stocks. It's not an inverse fund. It's a short selling stock. So it's designed to be held for those bear markets when you truly want to hedge. It's the only thing that has the more than likely ability to move opposite of the market when it's moving down. Right? It won't be perfect, but it's a way to get that hedge. And we always talk about using it when you sort of see the clouds on the horizon. You want to think about something like that if you're comfortable with that level of risk. But it's certainly a good ETF. The ticker symbol is DWSH, and you can use something like that to hedge in those rough markets.
Are there specific sectors that this ETF turns to in those types of markets, or is this done with the momentum work that the Dorsey Wright team does? How do they select?
It's all momentum, just like they do. So it's unconstrained, which is nice. It's exactly what you want. What you like about technical relative strength in the up markets and buying the sectors that are moving and not putting any limitations on you, it's really the same thing that you want on the downside, right? So you take those stocks at the bottom, the ones with the highest relative weakness, whatever categories those are, and that's what this ETF is going to short. So it gives you that best opportunity from a technical analysis perspective to give you that portfolio hedge.
Would that almost serve as a hedge for an investment portfolio?
It can, absolutely. So if you broad market exposure, now keep in mind it's U.S. stocks. They're shorting large cap U.S. stocks, but a lot of these companies have global exposure. So you're still getting a little bit of hedge if you've got an overall global portfolio, but it is U.S. listed companies and large cap. So that's really where it's going to provide the best hedge.
All right, Noah, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.